and welcome to another episode of Classroom. We've been talking about fundraising in various shapes and forms, whether you want to do it via an IPO or QIP. But there's been another one that's been coming back into the reckoning, and this one is called a GDR. What does it mean? Why do companies choose to do that? And what might be the benefits or negatives of doing that? This is, remember, still an equity instrument. I've got two experts joining in to talk about that this week. Akhil Hirani, Managing Partner at Majumdar & Co. and Raj Bhatt of Elara Capital. Gentlemen, great to have both of you on the show. Akhil, what does one mean when one talks about a GDR?
A GDR in its full form stands for a Global Depository Receipt. So it is a certificate issued by a depository bank outside of India to a foreign resident, which has underlying Indian equity shares of the issuing company. So effectively what it is that it's an instrument which entitles the holder to underlying Indian company shares.
Just to draw the difference also between the two acronyms, Akhil, what would be the difference between a GDR and an ADR? Is it only about the country where it's listed or something else?
A GDR, as I mentioned, is a Global Depository Receipt. The ADR is the US counterpart. It stands for an American Depository Receipt. So typically if an Indian company is trying to raise money in the US through depository receipts, then it would have to do an American Depository Receipt or an ADR. And for non-American issuances, typically in Europe or in Luxembourg, one would do a Global Depository Receipt or a GDR.
Raj, comment on that conversation. What would you line out then as the advantages or disadvantages of doing a GDR for a company?
See, advantage of GDR is that it is simpler, and the second advantage is it does not have voting rights, so it does not trigger any open offer or mandatory offer, from takeover court point of view. So you can have a single shareholder controlling more 30% without triggering any open offer. Disadvantage, I think the only thing that you cannot get, domestic institutions don't participate much in GDRs, although some of the domestic institutions do have offshore funds and they can participate. But their participation is very minimal. So that is the only con I can see. Otherwise, I think it's very positive. And sometimes people these days say QIP is simpler because of domestic again, because domestic institutions can take part in the issue.
Before we talk about the why and the what of it, Akhil, any reason why it's come back into flavor now? Is it because of the global freeze we had going that's coming apart now, or some other reason that GDRs have now become more popular as an equity raising instrument or money raising instrument for companies?
I mean, GDRs have seen, different cycles in the Indian issuer base. I mean, they became very famous and popular in the 90s at different points of time. So in a way, it's, a coming back of the GDR. I think, you mentioned about the credit freeze. I think that was one probable cause why they became famous again. I guess what it signified is that quality Indian paper does still have some appetite overseas with overseas investors who are willing to take, a punt on the Indian market on the back of these receipts.
If you had to draw a line, Raj, between doing a QIP, a domestic issuance, and doing a GDR, which one would you lean towards, and what might be the differences between the two instruments?
The only difference between the two is that QIP only qualified institutions can participate, and most of these institutions are the FIs or domestic institutions. So it's limiting the number of participants, because in case of GDRs you can have any offshore fund or individual or any entity can participate, but in case of QIP only those who have licensed FI can come from outside India. So it's a distribution basically.
Okay, let's talk about a company that wants to go out and do a GDR, Akhil, to raise, let's say, about 500 crores in terms of money. What would be the 1, 2, 3 step process to do that?
I mean, of course, if you are a large-scale Indian company, you would try and tap the Indian markets. However, the last 6 months have not been very kind to Indian IPOs, although, some of them are coming back. So assume that you're not ready for IPO over here. Then you do have the other alternative, which is a QIP, which a lot of companies have been doing, a qualified institutional placement. and assume you're, for any reason, not able to do that because of pricing or other problems, then you do have the GDR or the ADR alternative available to you as well. The one point that I'd like to highlight is that the GDR window, which used to be much more liberalized until a couple of years ago, has also tightened a little bit. So up until 2007, an unlisted Indian company could also do a GDR issuance abroad, but then the finance ministry issued a press note and curbed that loophole. So now you do need to be listed in India in order for you to do a GDR or an ADR abroad. So if you're purely unlisted, then you will be a little stuck. But if you are a listed company, then you have, I guess, the three options that I alluded to.
Okay, let's take a quick break. When we come back, more on the GDR process, more on why it suits one particular company than the other, and whether or not there are any negatives in choosing this via, as Akhil pointed out, doing something like an IPO or a QIP. We'll come back.